So let's start where we have stopped. So last week we were trying to discuss about investment tools. So we have discussed two tools actually: payback period and the accounting rate of return. Hope that you have done the ARR calculation on the project B, which again answers something similar to project A, right? So project A, we got the ARR of 29%, I suppose. The project B also we got the 29%. So means that we are not in a position to compare A and B when we get the same ARR. The two tools, the payback ARR, basically one is cash flow based, the other one is profitability based. So both have not taken into account of the time value of money, right? We just take the cash inflows and outflows, and we have not taken the timing into account and just compute when we are recovering our capital investment in terms of payback computation. When come to the ARR, what we have done is, so we have taken the profitability throughout the project, average profit, and then initial and residual value we have taken into account and divide by 2, and we got the average investment. There we have got the average investment. So average profit to average investment, we got the ARR computed. So in this scenario, as I just mentioned, A and B is ending up with same ARR. So then yet again, we are unable to say which project is good compared to the other, right? So any questions of those two tools, the computations, anything that come across that you were not familiar with or you are yet to understand, any ambiguity before we move to the today's one? Anything that you need further input? Right? If you don't have anything, so we can straight away move to the today's one. So the today's one basically bit of important terms of examination also, and we try to understand it through the time value concepts, right? Before that, two announcements. One thing is like there will be a evaluation sheet downloaded in the Google Classroom. So whenever you are free, please complete that and submit as it is, so that IBSL administration wanted that those evaluation forms in terms of each subject. So please do so when you have free time, not during the class. So later even you can do for all subject that you are attending classes. That's one. Number two, presumably we may have to, we have enough time, by end of October or early first week of November, we can continue classes so that we have ample time to do past papers also. That's a good news. And then IBSL is also planning to do revision classes, which aiming for the next examination cycle, probably starting maybe mid-November. So means that our exams may not be happening this year, I suppose. So probably it could be early January. So we have again ample time for us for the preparation. I don't recommend you to come for revision classes for development financing, because no point you are coming for the development classes revision. So what I am planning to do is I will do everything that I am planning to do during the revision classes during the normal class, so that everything you are very much comfortable, because we have adequate time, right? So if we can finish it off by another week, 2-3 weeks in normal sessions, then we can straight away go to the past papers, which we have not done during the class, right? Those are the two announcements. So completing the subject evaluation forms and the conducting of revision classes, possibly in starting mid-November. So whoever if you have friends that you want to recommend whatever IBSL revision classes, please do so, and probably they will announce, they will put the advertisement accordingly. Right. Then come to the time value of money. Right. So time value of money, again, very important concepts. So how we have trying to understand the time value of money is like very simple example, where the difference between 1 rupee or 1 pound now and year's time. So everybody knows that there is a difference, right? So if you say that you have 100 rupees today, and then you are trying to purchase something for that 100 rupees, and after 1 year, if you are going to do the same thing, you may not be able to do the same activity or same goods purchase or same services obtained for that 100 rupees worth. So that is basically the concept called time value of money. Because of that, there is a chance the value of money going down year on year. So why this is important for us is, if you are an investor, if you get 100 rupees today out of your investment, and if you are planning to get another 100 in years time, another 100 in 2 years, 3 years, like respectively, the value of the future hundreds will not be same as today's 100. So then you need to think about the timing of cash flows. So that's what we call time value of money, right? But if you remember correct, in payback period, we have not thought about this timing. Whichever we get in whichever year, we have taken as it is, the complete value. 100 today, next year, the year after that, third year, fourth year. So we have taken the same value for that 100, but practically it's not happening, right? So that's why we try to use these time value concepts, and based on that, we try to discount those cash flows. That's the word. Discount those cash flows based on a particular agreed rate to see what exactly the future value as in today's term. That is what the time value computations is. So before that, we need to understand why this change, why the time value, why this value of the money going down. That is because couple of reasons. Main thing is interest cost. Let's say if you put a deposit today, say 100, if you get a 5% per annum interest, what it tells you is you get additional 5 rupees at the end of this year. So 105. Vice versa, if you get 100 rupees at the end of year 1, instead of today, set aside everything, you lose 5 rupees, right? Am I correct? Because if you give 100 to your friend, if the friend is, returning back in after 1 year, if the same 100, what you got easily lost is that 5 rupees. Because if we are not given to him, you can put it to a bank where you get 5 rupees. That's the interest component you are missing. That's the opportunity cost you forgone. That's the difference between today and the future. Number 2, inflation. Remember, inflation may be 2%, 3%. Now it has gone to like 6.7 to 7%, means value of goodies could be changed due to this inflation. Maybe this inflationary impact has an effect on the goods or services that you are going to plan to obtain in the future. That's another one. Number 3, there are other risks to materialize the returning of the money. You know that, yes, you give 100 rupees to a friend, but after 1 year, we don't know what would happen. Whether he can return it, what is his investment scenario. some other factors like, COVID or whatever, these things could hamper to get that money back. So there are a couple of reasons may impact on this time value concept, right? So if you have today 100, so you are happy because it's with you. But if you think that you are getting from years time, 2 years, 3 years time, there are factors like these have an impact of returning that money as it is, right? So that is why we need to say same 100 may not have the same value in years time, 2 years, 3 years time. Technically we say, if you give 100, yes, I will expect today. If you give 108 rupees in 1 year's time, I'm okay. Because these factors will have an impact of this 100 to make a value of 8 rupees additionally. So then I'm fine. Means in years 108 rupees has a value of 100 today. In 2 years, I'm asking 115 rupees. Why? In 2 years, 115 means today 100. In the other way. That's how you see it in more physically, practically. So how are we going to compute that? So there is a ratio, there is a computation called annual interest rate is 10. I lend you 1 rupee now and we'll get back after 1 year. How much worth that one in the future? That's a question mark. It's a future value, right? The future value into 1 plus 10% is equal to 1. In other words, 1 divided by 1 plus 10%, or 1 divided by 1 plus R is the factor we are calling, right? So if you mean to say that 100 rupees of today has a future value of 91 rupees. Now we are going to compute that. We call this discounting factor, cost of capital, that is equal to 1 divided by 1 plus R to the, we call N. 1 divided by 1 plus R to the power N. R is the interest rate, N is the number of years. If the N is 1, means that the value of 1 rupee in years time is 1 divided by 1 plus R. The value of 1 rupee in 2 years time, 1 divided by 1 plus R to the power 2. Okay. In 3 years time, 1 divided by 1 plus R to the power 3. Let's take an example. Assume interest rate is 10, like similar. Then please compute the value of 1 rupee in year 1, year 2, year 3, and year 4. Take a couple of minutes and see whether what could be the answer. What is the year 1 value, year 2 value, year 3 value, year 4 value. Just simply use this equation 1 divided by 1 plus R to the power N. R is the interest rate, N is the number of years. Year 1, if it is 1, if it's year 2, its N is 2, if it's year 3, N is 3, if it's year 4, N is 4. Just, use a 10% interest rate and see whether what could be the future value of 1 rupee in year 1, year 2, year 3, and year 4. See whether you can compute that. See whether are you getting these type of numbers. This called discounting factor. Just to familiarize the discounting factor, I wanted you to use this 1 divided by 1 to the 1 plus r to the power n. So year 1, how much is the factor? That's the value. If it is, let's say 100 rupees, 100 into 0.909 will be the value after 1 year. So if somebody given 100 rupees, that will have today's value of 91. In other words, just to use that 1 divided by 1 plus r to the power n for year 1, 2, 3, and 4, whether you are getting these discounting factors, then we can further understand the any question on computing using of 1 divided by 1 to the plus r power n? Taruka, Padmendra, Judy?
No, sir, clear.
Clear. What about Samindri, Chandi, Hirosha?
Yes, sir.
Okay, fine. So that basically, this gives us how to compute the discounting factor, right? So whenever we, thanks Samindri, when we are giving the interest rates, then what you have to use is 1 divided by 1 plus r to the power n is the factor. We call discounting factor. So put the perspective for simpler language means that instead they say, I will give 100 rupees in year 1, 200 in year 3, 300 like that, so that you are not going to accept it is as it is. You say future value of 100 will have a present value of 100 into 0.909 if it is at the end of year 1. So if it is year 2, somebody would say, I will give 100 rupees, but your present value is 100 into 0.826. And year 3, somebody would say, I will give 100, but you say, no, I don't have the same value of year 300. My today's value is 100 into 0.751. In year 4, if somebody would offer you 100 rupees, like payback, you say, yes, I'll take fully 100. No, I'm not taking the fully 100. What I'm taking is 100 into 0.683. Hope that you have taken that, got that concepts. That is basically due to this discounting factor, right? So means that if somebody tells you, I'll give 100 in year 4, end of the year 4, but actually the today's value of that 100 is 68.3 rupees. That is what basically we have computed. Right. Now what we can do is, now we have 2 projects. You remember, we have project A, we have project B. Both these projects, we know what is our cash inflows, outflows. The first, say, first column will be year 0, 1, 2, 3, 4, 5. Second column could be cash inflow. Third column could be cash outflow. Fourth column could be net cash flow, because cash going out, coming in. So what we need is net cash flow equation column. Year 0, 1, 2, 3, 4, 5 is the first column. Then third column is a net cash flow for the each year. For example, year 0, you don't have anything inflow, only outflow. right? Year 2, 3, 4, that you have some positive cash flows. Year 5, you have some cash inflow plus residual value coming in. So we have net cash flow. Then column 4 is the discounting factor at 10%, like this. Year 1, year 2, year 3, year 4. Year 0 actually discounting factor is how much? 1. Why? N is equal to 0. If you put 1 divided by 1 plus r to the power n is 0 means whatever amount the n is equal to 0, then value is 1. If you use that equation. So technically, for year 0, discounting factor is 1. For the rest of each years, it will read as year 1, year 2, year 3, year 4. Right. If you have net cash flow, if you have discounting factors, then you multiply those things, you ended up with discounted cash flow. That's a last column. When you adding up all those things, you ended up with what is the net present value, because each year when you multiply that, you get some present value, that as per the equation. When you adding up all cash flows, you will have net present value. So with that, we ended up with, if it's a positive, we say we are accepting the project. The negative, we say we are not accepting the project. That's how we are trying to do for this project A and project B. So for the understanding purposes, I'll show how it has been computed for the project A, then you can do it for the B. Here, this is project A, year 0, year 1, year 2, year 3, year 4. This is the net cash flow, because though I have mentioned cash inflow and cash outflow, they have not mentioned the inflow and outflow. Instead, they have taken the net cash flow. See whether you understand this. Year 0, no worries, because 100,000 going out. Year 1, year 2, year 3, this has been given 45, 40, 35. When come to the year 4, we have 30 plus 20, because the 20,000 is the residual value, 30,000 is the cash flow, so 50,000. Then these are the discounting factors, these which you have computed earlier also for 10%. And as I was telling you, year 0, discounting factor is 1. Then you have net cash flow, you have discounting factor for each year, you multiply that, you have the discounted cash flow is coming here. Then what you have ended up with here, it's 34,380 is the net present value for this project. Generally, if you have a one project, if the net present value is positive, we will say we are accepting the project. If you have two projects, then we have to see which project has the highest NPV. We'll say we will proceed with that. First, take a minute or two to understand this computation. See whether that you are comfortable with discounting factor computation, you are comfortable with the net cash flow computation, then you are comfortable with this multiplication of these two and ended up with discounted cash flows and ended up with the net present value. There are four things that I just mentioned. See whether it is clear to you. If not, you can ask questions.
Excuse me, sir.
Yeah.
Due to network failure, I'm Rachini.
Yeah,
Logging my husband's name, Lakshan. Okay, sir?
No problem. That's okay. See whether that you have got right these concepts. Any area of ambiguity? Further clarifications? Chandi, Rosha, Padmendra, Taruka, Samindri.
So in this discounted factor, the computation is 1 divided by 1 plus r to the power n.
Fine.
One is the capital which we have invested. Is it, sir?
One is what?
The computation is 1 divided by 1 plus r to the power n. The calculation, the computation. One is it the capital which we have invested?
Actually, if you can take it as it is O, if not, you can straight away say 1 divided by 1 plus r to the power n is the discounting factor that multiplied by the capital, that is this net cash flow.
Right. Okay.
Right. Rather than taking 1 as a capital, that's easy for us to understand. 1 divided by 1 to the 1 plus r to the power n is the discounting factor. So that's the third column. Then that has to be multiplied by this net cash flow column. So it could be 100,000, 50,000 or whatever. So that's why we say second year 1 is 45,000 into this is ended up with 40,905. But later on, as Yasu correctly said, we are not computing discounting factor separately on this one. We just, take 100,000 divided by 1 plus r to the power n, because 1 into 100 is the same. Second year, so you have 45,000 as top and divided by 1 plus r to the power n. That's 1 plus 0.1 into 1. So we don't have any sort of segregation when you are comfortable with, but for the understanding purposes, discounting factor is 1 divided by 1 plus r to the power n into net cash flow relevant to particular year.
Thank you, sir.
Any other questions? Okay, now take a 3-4 minutes and go to the project B and do the similar exercise and see what are you ended up, what would you get. See whether you can compute the NPV per project B. So take a couple of minutes among you, and if you do have any questions, you can ask. What about Yasiru, Tanya? Are you okay with the computation? Great. So let's see the answer. If you do have anything, please let me know. Right. That's about for the B. See whether that you are getting the same answer. So only the issue might be at year 4 that you need to think about. There are some other cash inflows, that is the residual value. So you have to add that into account, and then year 4 cash flows are like this. And then we have discounting factors, then just multiply to see the discounted cash flows. Okay, so then A and B you compare. The best project is A because it gives the highest NPV. Right, so we have learned 3 main tools as investment tools, and then we move to understand the last one, that is the IRR, internal rate of return. So that is basically with the time value input, we try to see what is the rate produced by the project. And then how we are going to compare it is, let's say you are an investor, you have some money, and you might see what are the investment opportunities in front of you, right? And then you try to understand which project gives the highest IRR. Before that, you might think, if I am going to invest in a project, I need minimum of this much of return. That's subjective. Let's say you have some deposit, you compare with treasury bond, treasury bill rate, bank's interest rates. So based on that, you say, if I put the money into debenture in a particular bank, treasury bonds in a central bank, fixed deposit in a government or a private bank. So average maybe 7% I am getting. But if I'm investing my money in a project like that, maybe it's a steel, cement, fisheries, different projects, then I think with the risk premium and all that, I need 15% return. So that's my required rate of return, right? Then what should I get back from the project is, it should be beyond 15 because it is my objective. Whether high or low, it's different, but depending on the investor, depending on the risk criteria, one would presume that he needs this much of return of the project that if I'm investing. Then the particular project should give more than that what you're expecting. That's how we are going to compare with the IRR with the required rate of O, the return. Similar with the IRR also, if there's one project, you might say, this is my required rate of return. So I need to get more than that if I want to invest with you. That's one. Say if you have a couple of projects, then we have to see what is the highest IRR or ARR, like in the previous case, I am getting out of this project. Then I go for that. But remember, that should be higher than what is your required rate of return. Say you have some 7% is your required rate of return. And then each project gives ARR or IRR beyond 7. That's the first hurdle, first selection criteria. Then I go for the highest IRR or ARR. ARR is profitability oriented, IRR is time value oriented. That's the difference of ARR and IRR. Then how we are going to compute the IRR is more technically, IRR is the interest rate where NPV is 0. Now the challenge is how we are going to find NPV 0. Couple of methods. There's an equation here. Before the equation, I'll tell you, you can do it through graphical method or iterative method, or even in computer you have formulas. If you go to the formulas, and it will automatically tells you what's like a rate is. But since we don't have computer programs at examination centers, so what we could do is, like iterative method is something. Let's say in the project A, at 10%, we got some 34,000 or some NPV. Then NPV could come down when your discounting rate is, your interest rate is increasing. That's obvious, no? So it means that if you are expecting higher interest rates, mean your discounting factor could come down. Why? 1 divided by 1 plus R. If R is going to higher and higher, discounting factor could come down. Then the future cash flows also coming down. Time value of money also coming down. Hence the NPV is coming down. So we will assume 15%, what is my NPV? 20%, what is my NPV? 25%, what is my NPV? Luckily at 25%, project A gives some near 0 figure, which means NPV is 0, rate 25, IRR is 25. So that's the, we call iterative method. It's not advisable to do for examination. There is an equation to do so, but just for your understanding, NPV 0, at the particular interest rate, then we will take it as that interest rate as my NPV, IRR, rather. Right? So how we are going to select in that is the challenge, because this you can't do 10, 15 lakhs, so you keep on increasing, and then at a particular rate coming 0. So we decide that. But practically, how you're going to do is, there is an equation. That particular equation we have interest rate, particular NPV. Interest rate, particular NPV. So basically we have two NPVs, two related interest rates. But when we selecting these two interest rates and two NPVs, ideally it should be one positive, one negative. Luckily here at the 25% we got negative 0 here. If not, we need to select something double or triple interest rates compared to the first one, and you compute NPV again to get a value equal to minus. Then you have plus NPV, minus NPV, which you can use it for this equation. So how we going to compute the IRR? There is an equation. I'll show in a little while. For that equation, we need two interest rates and two relevant NPVs. One should be positive NPV, one should be negative NPV. Hope it's clear. If we have one positive, one negative NPVs and relevant interest rates, by substituting those into this particular equation, gives you the IRR for that particular project. But luckily in this equation, without computing the negative NPV, we ended up with a 0 NPV when we are increasing the interest rates up to 25. So as of this, without further ado, we can say NPV is 0 at 25, then IRR for the project A is 25. Let's see what is going to do with the project B. Right. Project B, when you select 25%, we ended up with negative NPV. That basically is our expectation. We need one positive, we need one negative. We need one positive NPV related interest rate, that's 10. We need one negative interest rate related, that's 25. So we have four variables or four inputs to ended up to compute the IRR for the project B. Okay. How we are going to do is, this is the equation. Right? And rather, I think IRR is equal to, that is, we'll say 10% is the interest rate 1, we can say R1. And $30,172 is NPV1 divided by NPV1 and NPV2. That's a total change in NPV, NPV1 and NPV2. We take only absolute values. We are not taking minus values there. Into R2 minus R1. That's a 50. I'll repeat the equation. IRR is equal to R1 plus NPV1 divided by NPV1 and NPV2. That's the absolute value or total change of NPV into R2 minus R1. That's a R2 minus R1 is basically the change in discounting rate. Change in discounting rate is a numerator. The denominator is a change in NPV, NPV1 plus NPV2. That fraction multiplied by NPV1, that's a 30,172, plus the R1 10% is interest rate. So ended up with IRR of 22%. Right. Just take a minute or two and use this equation again. See whether you also can get this 22% in terms of project B. I mean, just go through this and go back to this one, right? And apply it and see whether you ended up with the 22%, just to familiarize the equation. Take a minute and do your computation and see whether you have any gray areas.
So excuse me, can you repeat the equation?
Equation IRR is equal to R1, that's interest rate 1, plus NPV1 divided by NPV1 and NPV2 into, that is multiplied by R2 minus R1. So R2 minus R1 is the interest rate difference. NPV1 and NPV2 is the change in NPV. Remember, we are taking only absolute value. Why? Now we have obtained one positive NPV and one negative NPV. So we are not considering this minus pluses marks, only take the value of change. Plus, minus, you take only values and added up, that is NPV1 and NPV2. NPV1 is the positive NPV relevant to interest rate 1 R1. So if you take this equation, what is R1? 10%. What is R2? 25%. What is NPV1? 30,172. What is NPV2? Minus 7,482. But we take absolute value, that is 7,482 is NPV2. Just substitute these four values into that equation and see whether you also ended up with IRR of 22% for the project B. See whether you have any issue. you can take it in that way as well, Samindri, but better we say, if you can say NPV1 minus NPV2 and take that minus value, minus plus, that's it's the change of NPV. Technically how it comes, right? Absolute values comes in that way. For the simplicity, I just say take absolute. So irrespective of plus minus, you just adding up. But ideally, yes, how it comes is when you say interest rate difference, x2 minus x1. And when you say NPV difference, it's NPV1 minus NPV2 minus, it comes with the pluses. But for simplicity, we have taken the change of interest rates as the difference of higher interest rates to lower interest rate. And then in terms of change of NPV, we have taken both the addition of NPV1 and NPV2. But technically, how it arrives is, as you say, NPV1 minus NPV2. NPV2 is minus plus. So that's absolute value. Exactly correct. Great. Any other? Yes, it should be always negative, Samindri, because as our original explanation, we need to have one positive, one negative. If we don't get a negative, we can't compute the IRR. We always need one positive, one negative. Why? Originally, we discussed what is the interest rate equal to IRR. IRR is the interest rate where NPV is 0. So in order to become NPV 0, it has to come from positive to negative. Positive, coming down, 0, going down, negative. So positive to negative movements can be only experienced when we have one positive, one negative. So that's why NPV2 to be a requirement to negative. Good question. Any other? Any questions? All clear?
For me, it's not clear, sir.
Rashini, which one is not clear?
I have taken the NPV, the difference and the change of the interest rate as well.
Right. Change of interest rate is basically higher versus lower. That is clear?
Yes.
Fine. Okay. Then?
While taking the IRR,
right.
I couldn't get answer.
Right. So what is the equation for IRR? IRR is equal to lower interest rates, or I mean the interest rate 1, that's X1, R1, plus you have now NPV1, right? Divided by change of NPV, that is NPV1 plus NPV2, multiplied by change of interest rate, X2 minus X1. Now, X2 minus X1, you get 25 minus 10, 15. Have you got that, Rajini?
Yes, we'll take it as a percentage or as a number.
Either way, say 0.15 or 15%. If it is 15%, 15 divided by 100, or if not, 0.15. Or otherwise, you can just say 15% means that there should be 100 divided by that when it comes to conversion to the number, equal number, because others are numbers. No? Right. Then NPV1, you got 30,000, that is also correct, divided by 30 plus 7,000. Now, just see whether the answer is coming, like here. This is the 30, this thing, 37. When you say 15, so he just take as 15 because the because it's 10%, and then 30, 37 into 15%, he has taken, because all are this thing. If you take here 10%, 0.10, if 15.15, and you ended up with 0.22 here, if it is so. If you take 10% here, it's a 15%, because this is the fraction into 15%. It's ended up with something 12% or so. 10 plus 12 is 22. Is what we are troubling you?
Yes, sir. I got some 54 or something.
We have 54. When you say 15 is 30 divided by 37, how much? It's something 70 or something, right? 0.7 or whatever?
Yeah.
All right, that into 15 is something point or 12% or something.
Oh, okay.
Are you getting
Thank
it right now?
I'll check.
See whether, if it is not, we will explain it again. Samindri, what you have asked is, will they give us 1 IR? No, Samindri, possibly we need to, sometimes we need to compute for maybe IRR for both projects, right? So there the challenges, you need to decide two interest rates, one positive, one negative. Say in generally, whenever you are computing say 10% or 12% or whatever, you get some positive NPV. Then assume like 3 times more, 2 times more. Like if it is a 10%, you just take 25% or 30%. Obviously, there is a chance of getting is as a negative, because don't take 15% or 20%. So there may be less likelihood get the negative NPV. Ideally, you need to do one positive, one negative NPVs. In order to get one positive, one negative NPV, you need to have lower interest rate, discounting rate, and very higher interest discounting rate. So when you take 10% as the first one, then take 30% also, because you have one positive, one negative there. So then you just apply the numbers here. Is it clear? Right. What about Rashini? Are you okay with the computation?
Still no, sir. I'll try and let you know.
No, just let us know, because now later, yeah, we can switch it. But where that you have come across a difficulty?
In 22%, that's the problem.
How much? What are you getting?
I'm getting 0.53 or something.
0.53. So have you got the 10% correct?
Yes.
Sorry. Have you got this 30,000?
It's plus, no, sir? 30,000.
All are pluses. All pluses. 30,172 is plus. Have you got that?
Yes.
Right. Then divided by NPV1 and NPV2. What is NPV1?
30,172.
Right.
Plus
What is NPV2?
7,482.
Right. So when we take absolute values, when you added up it, you ended up with 30,654. Are you getting that?
It's 7,654. Yes.
Right. So what should be the division result? 30,172 divided by 30,654. What could be the answer?
I'm getting 3. I don't know whether I have do the fraction wrong.
No,
I'm getting
30,172 divided by 37,654. How much? 0.7 or point? How much? 8 or whatever? No? What is the answer?
okay. I just do the 0.1 plus 30,172 divided by the whole thing.
No. It's something 30,172 divided by 37,654. Total answer you multiply with 15% or 0.15 also.
Okay, sir. I got it all wrong.
Right.
Okay.
So otherwise you also can do is you can multiply 30,172 into 0.15, and that again divide by 37,654. You might have done worse, like you have multiplied 15 into 30,000. That is wrong.
Yes.
Because 15%,
Yes.
no. So then you have to take 0.15 if it is so.
Okay.
Because
Okay.
you can't like, percentages and figures just multiply until you put them the same base.
Okay.
Either you can do 30, 37, that is a fraction into percentage, then you ended up with a percentage.
Thank you very much.
12%, right? Okay. So further going on this discounting factors, what we can, the issue we might encounter sometimes now, they might give us a scenario like deciding the discounting factors. Here they have given the discounting factors, no, 10% or 12%, the primary one they would give. Then you have to assume about double that, maybe 25 or 30, so that you can do. So suppose now I was telling you on the other day, we have financing decision and investment decision are two things. But when you arrive these discounting factors, they might tell us, right, to arrive the discounting factor. For that, they might, give us some clues. Say, total is, say, 100 million. Out of that, say, 40% is debt, 60% is equity. Okay, example. Say, a 40 million at the rate of 15%. That is debt. In 60 million at the rate of 20%, or at the rate of 10%. Right. That is the question. So let's say we have a project, 100 million or something, right? And 40 million, I will take it as a debt as a percentage, 15%. Then 60 million, this is my equity, I'll put at 10% equity. That's why required rate of return. Then I need to, arrive the discounting rate, right? Discounting rate equal weighted average cost of capital. Mention like that. Now it's up to you to arrive the discounting factor. Earlier they said 10%, 15% is a discounting factor. They might not have given you that, and instead they say, I will try to fund this through debt component of 40 million at a rate of 15%. I'm planning to get it to bank, and equity of this much. Now you are supposed to compute the discounting rate, or the WACC, weighted average cost of capital. How are we going to do that? Take a try. Can you come with the discounting factor, suitable discounting factor for this project? The initial discounting rate now you are supposed to compute. See whether you can do that. What could be the answer? Any idea? Samindri? Karuka? Rachini? We're going to do that. We have now two sources. Okay. What about others? Erosha? It basically tells you, say you want to do a project, you see what are the sources of financing. One debt, one equity. Total project is 100 million, 40 million come in at a different cost, 60 million come in at a different cost. You need to do a weighted average cost. Now, what's the effective rate? It is not the 10, not the 15, right? That's what it say, no? Because earlier, let's say, now if we have only one interest rate, we did the easy computations using that as the interest rate or discounting rate. Then we have done the discounting factor computations. But here our interest rate need to be decided. So simply it's something, say 40 million into how much? 15% plus 60 million into 10% total divided by 40 plus 60. Is the discount for weighted average. Okay. Is it clear? Because 40 you get at 15%, 60 you get 10%. And total is 100 million. Now you get that WACC. 40 into 15, how much? 12. 60 into 10 is how much? 8. Right? Sorry, 40 into 15 is 6. 60 into 10 is 6. 6, 6, 12. Divided by 100 is something 12%. So that is the effective discounted rate for this project, not 15, not 10. Is it clear? Because sometimes we might have given in that sense. How we have arrived is, so we have taken debt into debt rate, equity into equity rate, divided by total investment. Debt plus equity. That into 100%. It is the answer. Is anybody is having not understood this computation? Anything you want further clarification here? Samindri, is it clear? Rachini, Karuka, Chandi, Andrew, Padmendra, Tanya?
Yes, clear, sir.
Yeah, Akilan? I'm not hearing very much from you today. Is it clear? Hirosha? Great, right. So basically, what I wanted to introduce that is sometimes, since this has been, testing us for about last 10, 12 sessions, every time we are getting question like this. So sometimes that the examiner might introduce a small, changes to this question. So if he, put this type of a thing, don't worry. Just you understand how should I arrive my discounting rate. That's the first question. If it has not given, then you need to compute it. How are you going to compute it? Because we have debt source and equity source. So debt into debt rate, equity into equity rate, divided by total debt and equity into percentage. That's it. Suppose here, if it is not 40 and 60, let's say if it is maybe 30 and 40, it doesn't come to 70, no, but you divided by 30 plus 40, 70. Then you ended up with 100%. Just take a particular fraction into percentage. Then you ended up with a common discount rate. Okay, right. We'll continue. Now, we have 4 criteria learned: payback, ARR, NPV, IRR. So when you are trying to learn this, if it's a single project, if you don't have multiple projects, there's a criteria to select. That is, if we have only one project, if you are using the payback, then your project selection is less than target period. Right? So if you think that you have some money, if you want to put up to a couple of projects, if you expect to get the money in 3 years, that is your expectations. So you look for the projects where payback is less than 3 years. That's simple. If no project is giving you the money within 3 years, you might say, no, it is not my preference. That's it. If there's a one project, you have some set prepayment or discounting or the payback period, and you compare the projects which gives you that. Sorry, if the one single project, you compare with your own payback period. If you have multiple projects, then you go the shortest payback period, like what we have done here, A and B. A was giving money compared to B, shorter period. Hence, we proceeded with the A payback. ARR, again, if you have one project above the target rate, you go with that. If you have multiple projects, highest ARR, you will take as the call. NPV is a single project. You take one positive NPV. Is a positive NPV? Yes, we will accept. Like this project, like this question, we have 2 projects. You went with the highest NPV. IRR, you have assumed target rate, expected rate of return, and higher than that target rate, you proceed with. If you have multiple projects with the highest IRR, you will be proceeding. That's how you do. If you have one single project, what is the criteria? If you have number of projects, what is your criteria? That's how the project selection based on the outcome of these computations. Hope I think it's clear. It's not very difficult, but if anything, let me know. Now, for exam purposes, we need to understand this also, because sometimes examiner would gives us to compare and contrast each of these methods, not stopping at the computation level. We are supposed to compare and contrast each method. So if you take payback, what are the advantages? Simple, easy to understand. I mean, no sort of number of things to do, right? Very simple, easy to understand, easy to use also. Their objective: cash flow, liquidity, commercially realistic, cautious and risk averse, the other advantage there, but ignores later cash flows. That's what we say, cautious and risk averse. Because in a project, after payback, you are not worrying about the future cash flows. Before that, you say payback is 2 years. I'm happy with that. So the cash flows happening beyond that, it's positive to you, but you're not so much interested because it says you are risk averse, cautious. Similar, it become a disadvantage also. Why? Because let's say if you have a couple of projects and you compare only up to the payback point, cash flows considered. Beyond that, there may be very positive cash flows on a project where you have not happy about. That cannot be used. That cannot be taken into account. Why? You have dropped it, right? So that's a disadvantage. Another disadvantage is to ignore the time value of money. In payback, you just take the cash flows as it is, no consideration of, no weightages being given to time value concepts. So two disadvantages: you ignore the time value, you ignore the cash flows beyond the point of payback. Those are two disadvantages. There are a couple of advantages also we discussed. Any questions? Anything that is not clear? Right, then we move to the ARR. ARR, what happened here? Again, simple and easy. It's used for both internal, external comparison, performance indication, performance measurement. It takes total life of the project. So it takes something new concepts like different concepts like profitability and investment, right? And is useful for us to compare the divisional performance, because ARR is like, profitability versus the investment, like return on investment kind of thing. These are something, the advantages. But disadvantages is subjective, because you take profit, it's a reported figure, right? Because when you say profit, yes, but when you are realizing the cash flows, may not happen in this year. So something, it's a misleading, because you are not taking the cash flows there. Especially we talk about project-oriented initiatives here. Cash flows are much important because these are new futuristic lending. Then again, time value of money is not taken into account, like payback is a disadvantage. Third one, when you have same ARR like here, difficult to compare, and the size also differ. Why? You take average profit to average investment. If it is a 10 million project, you get 30% ARR. It's a 100 million project, you also get a 30% ARR. Very difficult to compare because the size is not matter here, only percentages. You getting my point? When you say 10 million, the risk that you are getting is lesser compared to 100 million project. But if the project sizes are different, you can't use the ARR for a better comparison. That's what it says. Difficult to do so. But if it's a NPV, project size doesn't matter because it takes NPV and initial investment, everything, and do the NPV and do that computation. But here, ARR difficult to use when different sizes of the project. Or same ARR, then you are in trouble. Like what happened for us in this equation, in this example. You go to the next one, NPV. So NPV advantages are, we take obviously time value of the money, and it talks about shareholders' wealth because it takes total project cost in terms of time value. So basically it takes into account the wealth. It takes into account of the risk also, and it takes the whole life of the project also, not like payback. Here it takes the total life of the project. So from year 0 to end of the project. Total cash flows are taken into account, risk being taken into account, shareholders' wealth taken into account, and time value also being taken into account. That's the advantage of the NPV. So then what are the disadvantages of NPV? It's difficult to understand by managers. Why? Bit technical, right? There may be different computations, different terminologies, bit of positive, negative NPVs, right? So it's difficult, like compared to payback, compared to ARR. Those are easy to understand, easy to explain. But NPV, here that we experience is a bit of technical jargon. So difficult to be understood by managers, and again, difficult to convince, explain based on these concepts, the time value, discounting factors, weighted average cost of capital. So bit of difficulty. Adverse effects on accounting profits in the short run. Adverse effects, because now when you say ARR, we talk about profitability. But here we talk about a longer tenor. Project duration is also a longer. Then there may be, issues among managers, shareholders. Like shareholders prefer, long-term oriented. Managers' divisional performance important because we worry about day-to-day, yearly, incentives, bonus, and like that. So there may be some impact when you are using this NPV kind of concepts. Last one, how to choose discounting rate may not be easy. Maybe whether to go for the required rate of return, to add some premium and do that, depending on the risk profile of the project. Am I going to change it? Using the weighted average cost of capital we just discussed a bit earlier. So what's the basis? It depends. Maybe project officer takes this, sponsor takes this, banker takes another one, a consultant could take for another one. So like that, there may be some disadvantages in terms of choosing the discounting rate. Then go to the IRR. Advantage, obviously, time value into account. That's very clear. It's good also. Number 2, easy to understood. Now managers very easy to explain, right? So IRR higher, lower than the expected return. So we'll proceed with the project. Easy. Then disadvantages are like there's a vary in sizes like ARR. 100 million, 1000 million, or billion, 10 million, 50 million. So its size is going to differ. It doesn't reflect in the IRR because it's a percentage like ARR. And similarly, if you have a couple of projects give the same IRR because it's a percentage, again you are in a difficulty to choose which is good. 10%, 10%, 10%, 10%. 4 gives the same IRR. There are sometimes you experience there are 2 IRR also in a similar project because depending on the cash flows, timing, values, there is a chance of, the NPV positive, 0 to negative, again crossing 0 and go positive. Could happen. Then you have 2 IRR. Then you don't know what is exactly the correct IRR. Okay, so again you have some problems of selecting IRR where there are multiple or number of IRRs in a single project. So 3, difficult choosing if it's a various sizes, difficult to choose when I have the same IRR, or difficult in we have multiple IRR in a given project. Right. Any questions up to now? That's what we have taken. We have discussed during this topic. Yeah, what is project financing? Bit of definitions. Why, project financing or the is important. The nature, right? So then we discuss about the 4 methods. Some examples. We interpret the results in terms of one project, multiple projects, and how we're going to choose. Then finally we discuss advantages and disadvantages of each method. So very important area where we every time we see some sort of questions coming. Not difficult, but only thing is we need a bit of practice. You also can do it again and again. We try to do it at 1 or 2 questions, but since we have some more time, so let's see whether we have a question that we can attempt as a together. Before that, any questions on what we have done? Please let me know before moving to an area we need to do. Clear, Samindri, Irosha, Rachini? Akilan? Padmendra? Clear enough?
Yes, sir.
Okay, great. What about others? Rachini, are you all good? Samindri? Okay, thanks, Tanuka. Thanks, Irosha. Thanks, Samindri. Let's see that, I know not exactly everything could come into your mind in one shot because bit of technicality also there compared to, yes, thanks, Judy. See whether we have one sort of question that we can, get it here and give a try. see whether this is clear to you. Just a kind of question, but depending on time that we can attempt this. Is it clear?
Yes, sir.
Right.
Yes.
Right. Okay. I'll just read the question for you. Entrepreneur submits a loan application to fund an initial investment of 830 million on plant and machinery, which is expected to generate an income. Yeah, thanks, Hirosha. Flow 340, 400, 205, 580 at the end of first, second, third, and fourth year. End of the fourth year, machinery will be sold 90 million. That's a residual value. So first one is calculate the payback. How the break even is different from payback. Third one, NPV discounting, it's 18. Then IRR computation and how it differs from the discounting rate. So there are 4 things that we need to do, 20 marks. I don't see this is a kind of difficult question, but it's like good question that we can start it initially. Let's take one by one. So depending on time that we can complete at least part of the questions, later that we can complete it once at the revision stage, or I mean that the Q&A discussion. So let's take some time among you and see whether you can compute that. First one, the payback. As a collectively you can do. Right. Take 5 minutes and see whether you have any issue in the first one. In order to compute the payback, see what do you want. You have initial investment, then you have year 0 cash flow, that is 830 million, year 1, year 2, year 3, and year 4. Similar what we have done. Payback 2.44 years. It's like 3 years or 2.5 years as per some intent. What about others? So we can go with the not number 2, number 3. Number 2 is like explanation 1, clarification, break even versus payback, and you can do the NPV. What about others? Taruka, Rachini, Padmendra, Mirosha, Judy, Tanya. Yeah, Taruka, yeah, 2.4 years. Yes, you can also do the question number 3. What about the others? 3 people have got the answer. Rajini and Padmendra. What are your answers? Chandi? Are you getting differing answers or any Judy? Or the same answer? Tanya?
I got the same answer.
Fine, very good. What about Chandi, Irosha, sorry, Judy, Tanya, Padmendra? Possibly you got the answer, right? 2.44.
Sorry, sir, I missed the lesson.
So you didn't join us, so please go through on what we have done through the video and see whether if you have any questions, or let's discuss later.
Okay, sir.
Yeah, we'll do some question and answer sessions also. We'll do 1 or 2 questions so that you can get further familiarized.
Okay.
Anybody is not clear getting the 2.44? I suppose not. So then you can go to the third one. At 18%, what is the NPV? Take a couple of minutes and see whether you can compute that.
So have you given the discount factors?
Discounting factor, it's 18%. You need to compute the discounting factors. Discounting rate is 18. Yeah, we need to compute that. Okay, Samindri, let's see. Then Samindri, you can move to the fourth one. A discounting factor computation is 1 divided by 1 plus r to the power n. R is 18, n is 1, 2, 3, 4. Yeah, you can compute the discounting factor. Samindri, you can send as a text if you have the discounting factors computed for the benefit of others. What is year 1, year 2, year 3, year 4? Just give separate in a comma so that they can use that if they haven't computed. Just text it. Has anybody computed the NPV? Judy, Roshan, Padmendra? Thanks, Amindri. These are the discounting factors. Then you can use it and compute the NPV.
Sir, for the fourth year, are we taking the residual value as
Yes,
well, or the cash
that is net cash flow is basically the fourth year we have 580 plus the 90.
same to the NPV?
Yes,
Sir?
yes. NPV, like payback also we are taking, NPV also taking because it's a cash flow, cash inflow. Okay, actually you got also 215.74. Great. Then try for the last one. Rest can, yeah, great. So everybody is getting seems. Anybody is not comfortable in understanding or identifying cash flows? Any issue?
So, cash flows are 288, 287, 125, and 299.
No. The cash flows are 340, 400, 205, 580 plus 90.
No, I mean when
After the discount.
Yeah.
Discount. Maybe then what could be the like total addition?
It's 999.
900?
99.
Last she has taken wrong, I guess.
Yeah, I think it should be 580 plus 90 into the discounting factor. That's the cash inflows. Then the difference between 830 and that will be the answer, 215 or 225. Because year 0 we have 830 into 1, right? And the rest of the cash flow that is going out, all others are coming in. Maybe the last year you have to take 580 plus 90 into the discounting factor of 516. Then it's around 370 or something. 360 or so should be the last year. Yeah, actually, yes, you can do it at home and see whether what could be the issue on the So possibly, since that we have 18%, we have positive here. What you could do for the IRR is take 30% as a discount rate, right? And then for that, compute the discounting factors and see what is NPV. If it is negative, then you have one positive NPV, one negative NPV, one positive NPV related interest rate, one negative NPV related interest. There are 4 inputs. Then apply that equation. So we can discuss further if you have any issues in the question next week also. Let's try it in that way. Because at least you need to do a couple of questions before going to the exam. Since we just did the lesson, so it's good that we get this done with maybe 2-3 days period. So then you get further internalize the concepts. Then is everybody clear on the NPV now? Parminder, I'm not hearing from you. I suppose you have done it.
Yes, sir.
Okay, thanks. Then you can write at the last one at home. The rest also can do that. So generally, what we are trying to do here is we, in case of payback, we are not worrying anything about timing, NPV, time value and all that. We just take the cash flows and we try to compute when we are recovering 830 million, that's the initial investment, right? Only thing that you need to do is at the end of the 4th year, there is an additional cash flow of 90 million. That's a machinery disposal value. Then come to the third one. So they have given the 18% as the interest rate. Using the 1 divided by 1 plus r to the power n equation, you can compute year 1, year 2, year 3, year 4 cash flows. Year 0, sorry, this discounting factors. Year 0, obviously, the discounting factor is 1 because n is 0 means whatever you multiply, answer comes 1. That's why Samindra is, answer saying this is a discounting factor like this. Then again, you identified year 1, 0 cash flow is 830 million going out. 1, 2, 3, 4, all cash flows coming in 340, 400, 205, 580 plus 90. Then you multiply with that, then you end up with 215. That's a NPV for this project. Last one, you can do it at home. Since that at 80% you have got an answer positive for 215, then take maybe 35% also. Double the, yes, Samindri was telling about 25%, we get the negative NPV. That's great. Right? So apply 25%, get the discounting factors like you did in the 18%, apply that into the cash flows into the discounting factors, and then you get the discounted cash flows. We ended up with 2.75. It's a negative. Positive is 215. Then at NPV 215, you have a 18%. At NPV 2175 negative at 25%. Then it should be in between the IRR. Use that equation and see whether you can get the answer. Right. So let's discuss that if you have any queries next week. So once we are done this, we can now straight away move to the project appraisal, sort of everything kind of a conclusion of what we have done so far through the project appraisal discussion. So next week we will try to do that. So as I mentioned, couple of announcements. Yes, whenever you are free, please kind enough to complete the subject evaluation form, and possibly your revision classes to be started maybe from December onwards, maybe mid-November or last week of November, and might be conducted during the December also. So possibly the examinations could be January or maybe next year. So be ready for that, and try to as much as do your revisioning, since this is a very important area. And as always telling, so stay safe. We take all precautions. Things are still not good. Whenever possible, take the vaccines. So that's good for for ourselves and as the society at large. And thank you very much for joining me. So let's meet next week as 8 o'clock sharp, and have a very good week ahead. Take care, guys.